Good afternoon, everyone, and welcome to the Carpathia Capital webinar. I'm Paul Laud, one of Carpathia's founding principals, and I manage operational overhauls at portfolio companies. I'm joined this afternoon by Peter Kaufman, who heads up Carpathia's restructuring and distressed M&A activity. We're delighted you're joining us today and allowing us to introduce this innovative and unique financing solution to you. Carpathia is sponsored by Gordian Group. As some of you may know, Gordian Group has served the private equity community for decades. In combining Carpathia's core services, financial restructuring and operational overhauls, with capital, and then sharing the upside with old equity, Carpathia provides a rescue vehicle to private equity firms dealing with challenged investments. At the end of our brief presentation, we'll welcome your questions. Here's an email address you can use to submit them to us. And from time to time, we'll flash the email address again on the lower right corner of the screen.
This is Peter Kaufman. Again, thanks for joining us today. Carpathia Capital is the principal investment arm of Gordian Group, and it's the newest addition to our investment bank suite of services focused on the needs of the private equity community. Carpathia combines the unique equity-centric financial restructuring acumen of Gordian Group with the private equity turnaround experience of Gordian Equity Management Services, which is run by Paul. Gordian Group's experience base spans over 300 engagements involving more than $100 billion in liabilities restructured, and Paul's operational improvements have created hundreds of millions in equity value. We believe this is a powerful and special combination of expertise and services. So through these different operating divisions, several options are available to the private equity community. Number one, Gordian could be hired to restructure the balance sheet for you. Or Paul and GEMS can be hired to manage the investment through an operational restructuring and recovery. And now, third, through Carpathia Capital, you can convey the investment to us and this is key, we'll fix it, we'll restructure the debt, and we'll share the future upside with you. We think Carpathia's integrated approach allows us to bring a very potent one-two punch to distressed assets. We're going to create value for shareholders through both capital stack restructuring with an unconflicted and wholly equity-centric approach. We here only advise boards of directors looking out for old equity, and we do not advise financial creditors. So only we can give that kind of unconflicted, creative, and zealous and effective advice to restructuring debt. And that's all together with operational improvements under Paul's aegis. And we cement this all together with our capital to fuel the recovery.
When an investment founders, Carpathia can bring rescue capital, both human and financial. And Carpathia structures the investment so that it provides shared upside with old equity. The Carpathia model is built around a central premise. We acquire control while allowing the legacy old equity investor to benefit in future value creation. First, we bring fresh rescue capital to the company, along with a fresh bench of deeply experienced professionals that have navigated this particular course many times before. Second, we restructure debt to the benefit of old equity, retaining as much value for us and old equity as possible. This is unique to the Carpathia model. Gordian Group has led those types of restructurings hundreds and hundreds of times over the past 3 decades. We then set out to rebuild the business through a variety of operating initiatives that we'll touch on in a few moments.
There are many reasons and advantages to send a distressed signal to Carpathia. Maybe there's chronic investor fatigue. Many of you on this call may have seen or lived this movie before. It could be that there may be no additional capital available to invest and support the portfolio company. And perhaps there's a desire to bring closure to an underperforming asset while retaining upside and hopefully avoiding a wipeout. Could be that the fund's approaching the end of its harvest period or any extensions thereto and any overtime add-ons. Perhaps there's been a partnership transition, a decision not to raise another fund, or exiting principals or pressure from investors. Or maybe there's just more other exciting objectives or portfolio winners to devote fund management's time to. For any or all of those reasons, we're here to be helpful. Our investment criteria are straightforward. We seek companies that have annual revenues of at least $25 million. They should be EBITDA positive, or at least break even, but chronically underperforming. There may be debt defaults and unaddressed needs from amendments and waivers from your lenders. The company is struggling under a clearly unsustainable debt burden. If you have portfolios with these or similar characteristics and there is a need of rescue capital, send a signal to Carpathia.
For a moment, let's take a brief history break and a short history lesson. If you're familiar with the story of the Titanic, you may recognize Carpathia as the ship that raced to rescue the survivors of that infamous and tragic maiden voyage. At the order of Titanic's captain, Edward Smith, the wireless operator telegraphed the signal CQD, indicating all stations distress. Sadly, even at top speed, it took Carpathia over 4 hours to steam to Titanic's location. As an equity investor, you've probably been at a board meeting when a CQD, all stations distress, call was issued, or worse, problems were buried instead of being identified and addressed. You know the script. A missed budget, a missed revised budget, and even the revised budget. There are covenant breaches. Maybe you're now onto your 9th Amendment and waiver while you're still negotiating the 8th. Your mezz lenders are not biting and are being particularly obstructive. And you've been just regaled yet again with the management crisis of the week, along with yet another edition of missed projections.
So here's a quick look through the Carpathia toolbox. First, the balance sheet fix. Gordian Group is one of the nation's leading independent investment banks focused on advising companies, boards, private equity firms, and shareholders facing challenging and distressed situations. We've negotiated the restructuring of over $100 billion in liabilities. In fact, 2 of our partners, including me, have written the 2 definitive books in our field. And over decades of cases, Gordian has mastered the effective and creative use of carrots and sticks to achieve vastly superior restructuring outcomes for our clients, fueled by Gordian's and now Carpathia's unique approach of never representing financial creditors, so we alone can give unconflicted and therefore effective advice to benefit shareholders in tough situations. Carpathia's rescue capital is available to the company to fund operational initiatives, to provide sufficient runway to execute the recovery plan under Paul's aegis, and to provide the wherewithal such that creditors are aware that a war chest exists to fuel hostilities in the event that a favorable to old equity financial restructuring does not occur quickly. And that's terribly important, and it's extremely unique. The news of new capital and a retooled balance sheet will help reestablish confidence with vendors, customers, employees, and financial constituents.
Once the balance sheet is retooled and operating liquidity is restored, Carpathia executes on key operating transformations. By no means an exhaustive list, operational initiatives often fall into a few recurring buckets. The first, and singularly most important, is leadership, especially in the C-level suite. Carpathia principals have managed the delicate transition to new management teams many times before, successfully on-ramping, incentivizing, and socializing new leadership. The next bucket is process rationalization. For both service and manufacturing businesses, there are a host of well-known, tried and true quality and efficiency tools to deploy. Six Sigma, Kaizen, and 5S, just to name a few. These must be in place in order to make informed decisions regarding strategic capital investment or facility reconfiguration. Certainly the lifeblood of any business is understanding cost at every level of the organization. Many challenged businesses do this very, very poorly. A high priority in any turnaround is establishing robust diagnostic and predictive key performance indicators and dashboard metrics. As the old adage goes, what gets measured gets done. Developing new products and pruning older product lines often is sidelined when a company is in distress. With a strengthened balance sheet, the company can once again advance its offensive game. Here are two short examples. These are actual situations, though the name has been changed in the first example, but the numbers are actual. First, the story of Titan Products. Titan was a supplier to the residential construction industry and filed bankruptcy when the housing industry collapsed. As a result of the crash in housing starts, annual revenues, which had surpassed $100 million at the peak of the construction boom, had fallen to $24 million, and EBITDA had plummeted into deficit territory. When the company emerged from bankruptcy, its enterprise value was $27.3 million, roughly its net asset value, and with negative EBITDA, a wholesale operational restructuring and turnaround plan was required. With that short background, here are the remedial steps that we took. We recruited, socialized, and on-ramped a new operationally focused CEO. We shut down an unnecessary corporate headquarters and then consolidated two remaining manufacturing facilities into one. We introduced and drove Six Sigma, Kaizen, 5S, and other productivity and efficiency programs. We introduced metrics-based short and long-term bonus and equity incentive plans. And we launched new products. We lifted the team out of an entrenched bunker mentality that had taken root and launched new products, new pricing strategies, and new distribution channels. And here's what happened. As these interlocking initiatives took hold and got traction, EBITDA increased to greater than $15 million. And of course, a recovering housing market also helped. And as a very happy ending to the story, the company was sold for $115 million, representing a 4.25 times multiple of the enterprise value coming out of bankruptcy, which translates into an even higher step-up multiple on equity value.
So now I want to talk, this is Peter, I want to talk about a case study, small public company called TransEnergy. It might as well have been a private company. The principles were the same, and in fact, almost all the stakeholders of the company were on the board of directors. It was a public pure play Marcellus shale producer. They had a huge lack of liquidity, which led to the company being in default with a creditor, a fund that owed in excess of $100 million, or a debt to EBITDA ratio of 15 times. The company was in continuous default with its senior lenders due to weakness and volatility in the energy market before we were hired. We were brought on, we did a couple of things. We first negotiated with the senior secured lender, and we achieved a couple really special results. The first was that we negotiated for the shareholders to become pari passu with the bottom 40% of the about $125 million of senior secured debt, which was kind of amazing. We also obtained a discount on the upside held by the lenders if a sale could be effected within the next 12 months. Then we hung on and waited for the cavalry to arrive, and it did in the form of a small but important change in energy prices 2 summers ago. That led to us organizing a highly competitive bidding war amongst interested parties. And when we were engaged, the company's price was about $1 a share, thinly traded. And following our competitive auction, which had some special bells and whistles, the company was sold for $3.58 a share. This represented a premium in excess of 250% of share price, and it was aggregate consideration to the shareholders in excess of $200 million, a truly outstanding result. And with that, ladies and gentlemen, we thank you for your time and participation in the webinar this morning, or this afternoon, and we're going to take a few questions now that have come in during the webinar.
Thanks, Peter. First question comes from Sam right here in New York City. It asks, we're a debt fund and we have situations where the equity sponsors have bailed on us. Could that be a Carpathia opportunity? Very much so. Fundamentals are still the same. We can bring rescue capital to those, especially in a debt fund that is really a credit-focused fund. We will come in and put the risk capital in underneath the debt, and the model works substantially the same, but very much interested in situations where a debt fund, by design or not, finds itself as the controlling equity partner in a transaction gone awry. Next question from Gary in Connecticut. Would you consider acquiring an entire portfolio? Gary, I hope things aren't quite that distressed in your portfolio, but yes, absolutely, we would consider acquisition of an entire portfolio using the Carpathia model.
Next question, I think, is for me from Marie in Chicago. You mentioned carrots and sticks in your presentation. Can you give us some examples? Well, I guess I'll use TransEnergy as one example. You know, the fun part about our business, there's no cookie cutter set of reasons why a company gets into capital structure distress, and there's certainly no shortage of creative solutions to the problem, but we like to go to creditors and say, here's plan A. Plan A is you elevate old equity pari passu, you give us another year, you give us relief from covenants, and we want the lenders to say, well, that's ridiculous. Why would we even consider plan A? And so we want to be in a position to say, well, we think you're going to like that a lot more than you're going to like plans B and C. And plans B and C are definitely sticks. They are designed to not be silver bullets, because very few things are, but rather a credible threat that the lenders are going to have to take seriously. Could be a bankruptcy-centric threat that we're going to cram them up in a Chapter 11. Could be a host of other things, but we go into our laboratory and pretty quickly come out with something that we think is going to be effective in any given situation, and it usually, almost invariably, leads to a constructive, if unhappy for the lenders, negotiation around some form of Plan A.
Thanks, Peter. We'll take one more question. I want to be mindful of your time this afternoon. This comes from John in Philadelphia. What are your industry preferences, and will you do retail? Retail falls outside the Carpathia model. Other industries that we would steer clear of would be restaurants and real estate related transactions. Our wheelhouse, we're really focused on manufacturing and service businesses. Those work best under the Carpathia model. But interested in hearing any opportunities from our listeners today, and we will promptly turn those around and get back to you.
So in closing, we appreciate your time. We're very serious about this. Love to hear from you. We can't do enough for our private equity friends. And if we didn't get a chance to answer your questions today, we will reach out to you directly. Thank you very much. Have a great holiday.
Thanks very much.